Retirement experts recommend that as you get close to retirement, you need to have more of your portfolio invested in something conservative. It's practical that this would be the, mainstream advice. You don't want your portfolio to go through a serious loss right when you're going to need to take money from your portfolio. There's many methods that this is done. One of the most common approaches is something called bucketing approach, where you take a portion of your portfolio, set it aside in something conservative, while the growth bucket of your portfolio is continuing to grow to provide that financial security and inflation-adjusted growth over time. So then that leaves us with a few questions. How much should we have in each one of these investment buckets? And does the amount change over time? Or what about constructing this conservative safe bucket? Naturally, we would think of things like bonds and cash, but are there better things or risks that we need to consider when putting together this conservative portfolio? So I'm going to take a deep dive into how to put together this retirement income portfolio, and I'm going to focus on, for this video, how to construct this conservative bucket. You're going to learn some things about bonds that maybe you didn't know before. We're going to take a deep dive into some of the most common ETFs that are available in the market today, that are available to anybody essentially, whether you use Fidelity or Schwab or Vanguard platforms for your investing, or whether you're working with a financial advisor. So I think you're really going to enjoy this. It's going to be very helpful. Again, this is not investment advice. This is just meant to be educational, but I think you're going to get a lot out of it. So without any further ado, let's get right into this video. Now, I think I've shared this PDF in previous videos, but this is the framework that I use to answer the first question, which is how much of your retirement investment portfolio needs to be invested in investments that are conservative, and how much of the portfolio needs to be invested more aggressively. And there's many rules of thumb. For example, as you age, you just need to be more conservative. If you look at many target date funds that are available, as you approach that retirement age, which kind of by default with these mutual funds that are in a lot of 401k plans, your equity allocation is going to be something like 30 to 40% by the time you retire. But does that actually make sense? Those are some default investment solutions within 401k plans. But the way that I approach this is it's all based on your cash flow. So the simple acronym that I use is ABCs. So creating your retirement income investment portfolio is as easy as ABC 1, 2, 3. First of all, or maybe a breakdown of this, you allocate based on your cash flows. So what do I mean by that? So let's say you're retired, and in the first 5 years of retirement, you're retiring, let's say at age 62, and you're not going to claim Social Security until age 67. Well, that means that for the first 5 years of retirement, in this scenario, let's say that all of your income is going to come from the portfolio, selling investments or taking distributions from your portfolio. So essentially what you would do is you would look at the first 5 years of needed income. Now, to do this, you would probably need to start, the starting point would be to build out and map out your complete retirement plan. And I have lots of videos. And frankly, there's other great advisors and channels that have excellent content on that. But essentially, once you've built out that complete retirement income plan, and you know that for the first 5 years, you're taking out, for example, $100,000 per year from your portfolio, then what that means is that we now know we have the first answer as to how much you need to have invested in a conservative portfolio. So we're going to take 5 years of planned distributions, $100,000 per year, that's $500,000. And we need to set that aside into something conservative. Now, I'm going to go into detail about how could you do that, what specific investments you could consider in order to build that conservative portfolio. But first, let's just start with the basic framework. So you've set aside 5 years of cash flows into that conservative portfolio. Then you're going to take the remainder of your portfolio, and it's going to go into a nice diversified growth portfolio, which is going to be all stocks or, mostly stocks, US and international and emerging market stocks and all sorts of good stuff. I'm not going to go into detail for kind of that side of the portfolio for now. Now, as you go from year to year, so we're in year 1, we've set up our $500,000 because we have a planned $100,000 distribution from the portfolio. Now, with every single year, we're spending down $100,000. We look out to that next year, so we're going to look out to year 6 and say, what is the planned amount of income that we're going to need from the portfolio? Well, in our example, this retiree in year 6 will be claiming Social Security. Well, since we've mapped out a retirement income plan, we know how much of their income is going to be covered by Social Security. So let's say that that's half. So now in year 6, they don't need $100,000 from the portfolio. They only need $50,000 from the portfolio. So what we're going to do is we're going to go ahead and recharge so that we have a continuous 5 years worth of cash flows set aside in the conservative portfolio. So that year 6 amount from the portfolio is $50,000. So we're not going to refill that conservative bucket with another $100,000. We're going to refill it with $50,000 because that's the amount we need from the portfolio in year 6. So as you can see, for somebody who, like our hypothetical retiree, is going to have other sources of income like Social Security, the amount they need in their conservative bucket is actually going to decrease over time. So if we look at the first 5 years of retirement, they need about $500,000. But if we look at years 6 through 10 for that 5-year period of time, they're going to need half of that. If we assume that Social Security is going to take care of half of that planned $100,000 of income, because 5 years at $50,000 from the portfolio, the other $50,000 of course being satisfied by Social Security. Now they don't need $500,000, they only need $250,000. So this is interesting. It's something that I've just observed being an advisor to retirees over my career, which is that often somebody's portfolio might actually get a little more aggressive over time. Now that's obviously something that can be adjusted based on somebody's preferences, which obviously need to be taken into consideration. They're very important. But just as a starting baseline, somebody typically can get more aggressively invested over time just due to this approach of investing based off of cash flows. Now, when we look at refilling that bucket, you'll notice on the screen here in that bonds portfolio, it says 3 to 5 years. And the reason why I have that is because some years the stock market is going to be down. And it's not catastrophic to your retirement plan, but it's certainly not ideal to have to sell investments out of the growth portfolio right after you've had a big stock market decline. So that 3 to 5 years is meant to be really a buffer so that if you get to the end of one of those years of retirement and the market has had very poor performance, it's negative or something like that, you can go ahead and delay refilling that safe bucket of money until maybe the next year or maybe even the year after, so that you're not forced to sell stocks at market lows. You can wait for those investments to recover in value before you make those trades. And that's something that can help mitigate or manage what we call sequence of return risk. Retiring right into a market downturn can be catastrophic if you're having to sell stocks as they're declining in value. So this is the basic framework. Now let's jump into the details about what you should look for in bond funds to build out that safe part of the portfolio. So I'm going to jump over to my investment software and we'll take a look at that. Okay, I've loaded up on the screen 4 different bond funds. And so if you look up here in the top left corner, I have SGov. Now these are all ETFs or exchange traded funds that basically find them anywhere. There's nothing special about them per se. And again, this is not investment advice. This is meant to be educational. And these are just some good, low cost, widely available investment products that I can use for illustrative purposes. So all 4 of these are low cost, widely available bond funds, but they're all very different. Just like in the same sense when we talk about investing in stocks, somebody could be day trading tech stocks or, bio stocks, or they could be invested in a diversified index fund. So, you can see those 2 different types of stock investing are very different. And actually the same thing applies to bonds. There's many different types of bonds. So this is going to be helpful. So when you're looking at bond funds, there's a couple of criteria that we want to look at as a baseline. Man, I've said that so many times in this video, as a baseline. But when you look at an investment product, one of the things you always want to consider is the expense ratio. How much you have to pay. What is that internal expense of the bond fund? Because it's relevant. All else being equal, if you can reduce your fees that you're paying, it's going to be better for you. Now, let's go through the other things that are specific to bond funds. The first is the credit quality of the bond fund. So again, very simply, when you invest in bonds, these are loans that you're making. You are loaning your money to either governments or large corporations. You're essentially lending them your money and they are promising you some rate of interest in return. Now, because these bonds are not made just it's not just a loan from the bank, between you and the bank. These are loans that are available to everybody. They trade on the open market, so their values can fluctuate up and down based on different things. But the first criteria is the credit quality. So if you're lending your money in a bond fund to somebody with perfect credit, and in the investment world, what that amounts to is basically the United States government, guaranteed to get your money paid back. Or let's look at, a company with good credit, let's say, because that's basically how it works, would be a company like Apple, right? You lend your money to Apple, there's very little doubt in any investor's mind that money is going to be paid back. It's going to be paid back. Almost certainly, not guaranteed, but right, you see what I'm saying? It's a very, very safe assumption. Now, let's go down kind of the credit quality scale, and let's say you're lending your money to a company that is on the verge of bankruptcy and they need to borrow money to try and execute some turnaround plan for their business. Well, you could see in that scenario, the risk of not getting your money paid back is a lot greater, right? So with the credit quality comes a different rate of interest. So all else being equal, if you have a higher credit quality lender, like the government, or a company like Apple, they're going to get to like somebody who has like an individual that has good credit. The interest rate that they are going to pay is going to be lower. Now, if you lend your money to a company that's maybe in a tough financial situation, for you to feel incentivized to lend your money to that company, you're going to demand as an investor a higher rate of interest. So, as a basic rule, the higher the credit quality, generally the lower the interest rate that you're going to receive as a bond investor, and the lower the credit quality, the higher the interest rate that you're going to get. Kind of makes sense. It's fairly intuitive. Now, the next thing that is very critical for a retiree when it comes to bond funds is the duration of that portfolio. What do I mean by that? I'm talking about the length of the loan. So when you're loaning money through investing in bonds, there's generally a term. Like for example, when you get a mortgage, you're being lent money over a 5-year or a 15-year or a 30-year period of time. And usually that interest rate is fixed. I won't go into all the details. With bonds, there's every variation under the sun. You have fixed rate and floating rate bonds and that sort of thing. But for what we're talking about right now, talking about the duration, the length for that loan to be paid back. And so very common durations, you have things like 1-year bonds or 2-year or 5-year or 10-year or 20-year bonds, 30-year bonds, more common with things like the US government. And the reason why that duration, the length of those loans is relevant to investors is because the longer that duration of the bond fund, the more sensitive your bond fund's value is going to be to changes in interest rates in the market. So for example, let's say that you invested in a 30-year bond fund and it was paying, when you invested your money, it was paying 3% interest, okay? And now let's say that, a couple of years later, somebody else can invest in a 30-year bond and earn 5%. Well, you as the holder of that bond that you contractually agreed to a 30-year payment at 3% interest, some new investor, let's say you wanted to sell your bond fund to somebody else. Well, they're going to look at you and say, well, I'm not going to pay you full price for your bond because your bonds only pay 3%. Why wouldn't I just go out into the market and buy someone else's bond that pays 5%, right? It makes sense. And so what happens is if you buy a bond fund and interest rates in the general economy go up, the value of your bond fund is going to go down, generally speaking. Now, the inverse is true. Let's say you buy a bond fund, same example, a 30-year bond fund that pays 5% interest. And interest rates in the economy now, let's say they go down in value. When you invested, it was 5%, but then in the general economy, interest rates drop to 3%. Well, you've got a bond fund that pays 5%. So actually what will end up happening is the value of your bond fund is going to actually go up. And the longer the duration, the longer the length of the weighted average of the bond portfolio, the longer that duration in years, the more sensitive that bond fund is going to be to changes in interest rates. So on the screen in front of us, we're looking at 4 different bond funds, and this is going to give us a really good sense of how these two things play out in real time. Duration, the length of the bond maturities, and then also the credit quality. So this green line here, let's look at year to date. So here we are in 2026 in April, and we're looking at these 4 different bond funds. In green here, we have SGov. This is a basically perfect credit quality bond fund and very short duration, 90-day loans to the US government. It's basically the same thing that a money market fund is made of, right? Then we have BND, another ETF from, this is a ETF from Vanguard. And this is kind of like a broad, it's kind of like the S&P 500 of bonds. So it has a diversified mix of short-term and longer-term and both government and corporate bonds. And that's here in blue. In orange, we have JNK, which is, short for junk bonds, this is a bond portfolio that pays a higher rate of interest because these are bonds going to companies with lower credit quality. Then we have TLT. This is a 20-year plus U.S. Treasury bond ETF from iShares. These are longer duration bonds, but again, perfect credit quality to the U.S. government. And you can see that over time, although we have 4 very common bond funds, their performance is very different. So just looking at 2026, you can see the variation in returns. So most notably, we have the green line, which is difficult to see, kind of have to focus here, but it's just this very gradual, almost perfectly, very little volatility in the price. And in contrast, if we look at, for example, the TLT bond fund, as we go through the year, we get to February, and all of a sudden it spikes up in value February 27th, right? So probably what was happening, if I looked at another chart, interest rates were probably coming down a little bit, and so the value of that bond fund was going up. Like I said, they're more sensitive to interest rates. And then it comes back down. Kind of interestingly enough, all 4 bond funds kind of end, the middle of April at about the same place, but you can see the path that they followed was quite different. Let's look at another year that gives a really good illustration of the effect of duration. So we're going to go to year 2022 and actually look. I've already got it pulled up. So make this chart a little bit bigger, a little bit larger here. So here we are in 2022. And if you don't remember, a little bit of a reminder, 2022, very high inflation in the United States. So what was happening? Federal Reserve was raising short-term interest rates. And so remember kind of this example that I gave, as interest rates go up, the longer the duration of that bond fund, the more it's going to be impacted. So when interest rates go up, bond value went down. So check this out. We have the green line here, SGov, and because these are very, very, very short duration bonds, 90-day duration bonds, you can see that the value of this was just steady, really not going down at all. Where on the flip side, you have another bond fund that's also invested in 100% government bonds, this kind of purplish here, TLT, and you can see that with the rise of interest rates, this bond was very negatively impacted. It was down over 30% in just 1 year. Now, if you're investing in a government bond fund, I doubt that you would expect, you think that this is basically impossible to lose 30% in your bond fund. But it's not because the credit quality was bad. It was all about duration. Duration is what created the impact here for this particular case. Now, as we look at JNK and BND, you would think, you know what, BND, this is a more diversified bond fund. It's going to hold up better. And JNK, it's lower credit quality. Maybe it's not going to hold up as good. But you can see here, these two, the blue and the orange, they basically follow a very similar path. And they end the year in a very, very close to the same spot. BND, the kind of S&P of the bond market, is down about 13% for 2022, where JNK was down about 12%. So you can see here the real difference between these two bond funds and what resulted in this performance had more to do with duration than it had to do with credit quality. So you can see here that as you're building this 5-year bucket of money, being very aware of the duration of your bond fund can have a huge impact on the stability of that safe portfolio for your first 5 years. Maybe let's look at another year where we can maybe glean some other lessons. So I'm going to go back to 2020 because this was a year where there was a big economic shock with COVID, and we can see kind of a dispersion of performance. Now, this chart's a little bit funny because SGov wasn't created until May of 2020, but you can see it's a very straight and flat line. So just imagine this kind of continues back because that's essentially what would have happened. But you can see the performance of the different bond funds, how they were impacted by economic environment and the interest rate environment. So this is kind of the inverse of the story of what happened in 2022. You can see that in 2020, here we are going along, we get into April, we get into February, and all of a sudden, oh no, there's this COVID thing and the world shuts down. Well, a few things happen. The economy is very negatively impacted. Newsflash, when you shut everything down, it's not good for business. So look at JNK. This is a bond fund, like I said, that's more susceptible to credit quality. So businesses that are not as financially strong. So to me, it seems very logical and makes sense that this bond fund was really negatively impacted by COVID, right? As the prospects, oh no, what's going to happen? Are these companies going to be able to make their bond payments? The value of the bond fund goes down almost 22% or just over 22% at the lowest point. Now, at the same time, BND, higher credit quality, yes, it was negatively impacted, but you can see here the effect of the credit quality on the investment performance. Yes, it went down, but it held up much better than JNK. And kind of interesting, talking about duration again, here we have TLT. As the world was shut down, there were many kind of government emergency measures that took effect to mitigate the situation. And one of those is that the Federal Reserve took interest rates all the way down to almost nothing. So again, as interest rates in this case, there's a inverse relationship between interest rates and bond values. So as interest rates in the general economy went down, the value of existing bonds went up. And that relationship, or the severity of that rise or fall, again, is based on the duration of the bond fund. So here you see TLT, because it has the longest duration, it was most impacted by that interest rate change. So as interest rates drop significantly, the value of this long duration bond fund shot up. You can see it shot up and almost up, 26%, while at the same time, JNK is down here in negative territory. Now, at the time, if this was part of a diversified portfolio of stocks, this would have been a very good diversifier. Your stocks are dropping in value while this, bond fund is having a large gain at the same time. It would have really helped to stabilize your portfolio value overall. So then it comes down, you can see at the end of the year, the long duration bond fund was up about 18%, where BND, the S&P of the bond market, was up about 7.5%. J&K, lower credit quality, was up about almost 5%. And then SGov was up just almost nothing, 0.05% for the year. So I show all these charts, and depending on the year, if you knew what was going to happen with interest rates, if you had kind of this crystal ball looking into the future, this could be a way, understanding how duration impacts bond values, could be a way for you to maybe increase or you make your overall investment return even better. But what I think is very important for a retiree is that I would advise against trying to get growth and really trying to maximize capital gains out of your bond portfolio. When you create this retirement investment approach of having these two buckets, that first bucket of bonds, it's just about stability. Yes, it's great to earn a couple percent of interest, maybe kind of break even with inflation. And more important than anything else, it's stability, because you don't want to have to be selling those investments as they're going down in value. So out of the different bonds that we looked at, maybe what is the bond investing style that is most immune to both credit quality and duration risk? Well, that's going to be a short duration bond fund like SGov. Interest rates go up or down, you're just kind of steady earning your interest rate. Now, granted, if interest rates go down, yes, on a go-forward basis, you're going to have a lower interest rate payment. But remember, the growth in your portfolio for a retiree is really coming from the stocks. That's where you're going to get that inflation-adjusted growth to kind of maintain your financial security over time. That bond portfolio, we're really just looking for stability of cash flows. So personally, I like to have for my clients a large amount of their safe money invested in something more like SGov compared to something like TLT, some long duration bond. And then frankly, when it comes to bond funds like J&K investing in high yield bonds, they don't appeal to me. And I think that most advisors include those in the portfolio when they have clients who are afraid of investing in stocks and they want to try and give their clients some kind of stock market like returns and still call it a bond. They'll use funds like J&K for something like that. So at any rate, I hope that this video has been very valuable to you to help you understand not only how to construct the framework of how to create a retirement investment portfolio, but then specifically when you're creating that safe investment portfolio, what are some of the specific types of bond funds that you could use? What are some of the pros and cons of the different bond funds that are available, and the impact of things like credit quality and duration? If you would like some help looking at your retirement investment portfolio, I'd be happy to sit down with you. You can click the link in the description for a free one-on-one consultation. And until next time, as you get ready for retirement or you are in retirement, I really hope you have a great week, and I'll catch you in the next video.